And good morning again, options traders, and I hope everybody had a fabulous weekend. Today, we're going to answer a question that was posed by one of our traders here in this group, and he was asking about this idea of hedging shares of stock. And should you use in the money or out of the money puts? And it's a very good question. It's a common one because if you are using in the money puts, it seems like you're getting something for free, that you're able to lock in a guaranteed gain. And that's why a lot of people even entertain the idea of using in the money puts. But once you really see what's happening, you'll realize that there's very little reason for ever using in the money puts to hedge shares of stock. So why is that? Let's go find out. As always, before we do, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So, quick review for anybody who might be new to put options. We have two types of options in the market, calls and puts. A put option gives you the right to sell shares for the strike price or the exercise price. And so if you have shares of stock and you buy a put option, yes, you could think of it as an insurance policy. You have the right to sell shares for whatever that strike price is that you purchased. So even if the stock price goes to zero, there's an amount that you're guaranteed to get back. So put options become really kind of a dual purpose. We can buy them by themselves. So this is a $100 put purchased for 5. And remember, we always get a bend at the strike. We've got these negative deltas out this way. So if you buy a put by itself, it's acting as a hedged short stock position. We can make money if the stock price falls. That's why we have these negative deltas out here. It just means this line is leaning out this way towards the upper left corner of the chart. But over here on the right, we go flat. We can't lose beyond the amount that we paid. However, if we bought this same put, this same $100 put for 5, and we owned shares of stock currently trading at 100, then those would be the shares of stock, and we also have this put. So what's the combination? What's the combined risk graph? Well, remember, this line over here, or 100 shares short, is going to cancel out with your 100 shares long. So those just kind of go away. And if we look to the right, you have 0 deltas out here on the put. Remember, you can only lose the amount that you paid, but you still continue to own the shares. You're just not taking losses below the 100 strike. So overall, your risk graph goes from this black plus red to just flattening out this left side. And again, that's because every dollar that's lost on the stock as the stock price falls is being gained by the amount in the put. So they just tend to offset each other. So your net position is this. So many of you remember that stock plus put is a synthetic call option. So yes, it's going to look just like a call option. And so that will also give you some insights into what's happening when you buy an in-the-money put to hedge shares of stock. Mathematically, you are buying out of the money calls. So here is the resulting position. So now you can clearly see it looks like a $100 call. But remember, what we're holding is shares of stock, 100 shares, plus this $100 put. We paid $5 for the put, and look at this. That's still the maximum loss, but we've just flipped our deltas from negative to positive. So once you understand that buying put options against shares of stock is acting as an insurance policy, it'll give you a new perspective because we can also look at them as call options. So remember with put options, if you are using them as an insurance policy, which is really what this person's question was, he had shares of stock and he's saying, should I use out of the money or in the money puts? Well, think about an insurance policy. You've got stock plus a put, and that's going to equal a call option. So let's go back to our shares of stock purchased for 100 or that are currently trading for 100. And let's say that you decide to buy the 105 put. You want to buy an in-the-money put. Now, the reason that people think to do this is they're saying, well, hey, if I own shares of stock, maybe I just bought them for 100, but I can go out and buy a 105 put. And therefore, I'm guaranteed to receive 105 bucks. I'm guaranteed 5% on my money, and yet I might make even more. Well, it sounds like a great idea, and Ask yourself, would it be a benefit to buy stock at 100 and be guaranteed to sell it at 105? Well, of course it would. And as I've talked about many times in previous videos, if there's a benefit, you must pay for it. How much? The size of the benefit. So you know that this put has to cost at least $5. There's the kicker. That's why you're not insuring anything. So does this guarantee a $5 return? Of course not, because you're going to have to pay at least $5 plus some extrinsic value. So if we go back to our shares of stock and we buy the 105 put, what everybody thinks is going to happen, that the resulting risk graph is going to go to this. They think that they're going to lock in this $5 gain because they've bought this $105 insurance policy. But once you realize that you've paid $5 for that, all it's going to do is bring you right back here to zero, and it's actually going to bring you a little bit below because you're going to pay $5 plus some extrinsic value. So in this graph, I'm assuming that you've just bought that put at parity. Stock's at 100, you bought the 105 put for exactly $5. This is your risk graph. Notice what you've done. The stock is currently here at 100, but now you're not making any money until above 105. Why would you do that? If the stock is 100, wouldn't you want to profit for all of those dollars between 100 and 105? Why would you just want to flatten out? See, there's no benefit in paying $5 to insure $5. So think of it this way. What if I tell you, give me $5 today, and in, let's say, 30 days, I'll give you the $5 back? Would you think that you've somehow guaranteed $5 or that you've got a free $5 coming back to you? Well, of course not. It's just a return of your own money. And that's exactly what's happening here. If you pay $5 for the 105 put, for shares that are currently at 100, you've spent $5. And yes, you're guaranteed to get $5 back, but it's your own $5. But in addition to that, you will also pay some extrinsic value. So again, you have to just really ask, what's the point of buying an in-the-money put? It just doesn't make a lot of sense. Now, what if you, let's say, did the 110 put? You bought stock for 100, or it's currently trading for 100, and you buy the 110 put. Are you going to lock in a $10 gain? Well, of course not. That's going to cost at least $10. And assuming the bare bones minimum of $10, just trading at parity, now you're going to look like this. Stock is back here at 100, and all you've done is you've shoved this break-even point out $10. So look at this graph. If the stock goes from 100 and starts moving towards 110, if you just kept the shares of stock, you would start profiting up here. But now you're not going to profit until the stock gets above 110. You're just sitting flat for the next 10 points. Now you might think, hey, but check out the left side. I can't lose anything if the stock falls. Yeah, that's true, but it's just a return of your own money. See, it's not really doing anything beneficial in terms of being an insurance policy. Stock is way back here. You might as well profit if it rises. So go back to the whole concept of insurance. No matter what type of insurance you're buying, whether it's put options to guard shares of stock or car insurance, home insurance, it should be for things that are low probability, meaning they don't happen that often, but that are high severity. It's going to be really damaging if it does happen. So your house getting swept away in a hurricane would be high severity but low probability. That's a good candidate for insurance. But even in those cases, you should be willing to accept some risk. The worst thing that you could ever do from an insurance standpoint is to say, I don't want to accept any risk whatsoever. So if a bug hits the windshield on my car, I want a brand new windshield. If somebody breaks a taillight by shoving a shopping cart into the back of my car, I want a brand new taillight. I want everything fixed for no cost to me. Well, sure, they'll sell you a policy like that, but you're going to find out it's not worth it. Because you're just going to, just like with the put option, you're just getting a return of your own money. Because those things are so likely to happen, you're just paying for them up front. And so once you understand the real reason for using insurance in the first place, it really makes the most sense to use out-of-the-money puts. So for example, let's say our shares are at 100 and you buy a $95 put for 2. Notice the cost of the insurance has gone down because it's out of the money. You are assuming some of that downside risk. You own stock at 100, if it falls to 95, you're taking a $5 hit. And then you are able to sell those shares for 95, but you're assuming the first $5, just like a deductible. So notice what happens. Stock's at 100, you pay $2 for this out of the money put. Your cost basis is 102, just adding the stock price to the cost of that put. But you're guaranteed to receive $95 if you exercise that put. So you could look at this as a synthetic $95 call for 7. It's in the money by 5 points. And then you're paying $2 for the insurance policy to not take losses below 95. So again, if you don't have the shares, it just makes a whole lot more sense to buy the call. It's the same difference. But if you already have the shares and you're looking for insurance, then it would make sense to buy the out-of-the-money put. Now you might be thinking, well, wait a minute, if I paid $2 for this put, how come it looks like I can lose 7 if I own the synthetic $95 call for 7? Well, again, you are potentially giving up $5 of intrinsic value. Stock's at 100, you're giving up that first $5 plus another $2. And so again, it's this idea that you are potentially giving up $5 of intrinsic value that's really kind of adding to the cost of this call. So if you own shares of stock at 100 and you buy the $95 put for 2, you're not limiting your losses to $2. It's to 95 plus this 2. So you've got a $5 difference here plus 2. Your risk graph would go to here. And notice that it sits at -7. But you have a 95 call for 7 with the stock at 100. So you're only pushing that break-even point out $2, but you still have an insured downside. So you end up with this risk graph, whether you buy the $95 call for 7, or whether you own shares and buy the $95 put for 2 and give up $5 of intrinsic value. It's the same graph. So again, if you're using put options to insure shares of stock, it makes a whole lot more sense to buy an out-of-the-money put. However, if you're buying an in-the-money put option as insurance, remember synthetically you're just buying an out-of-the-money call. That doesn't make a lot of sense from an insurance perspective. From a speculation standpoint, it does. If you're buying out-of-the-money call options for, let's say, pennies on the dollar, yes, you can leverage into a lot of shares or a lot of deltas for very little money. But that's not an insurance policy. That's a risk-seeking behavior. And again, that's what you're doing if you're using in-the-money puts to hedge shares of stock. So if you want to hedge your shares of stock, use out-of-the-money puts. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. You can find it all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.